And big thank you to all the panelists in-house and especially Bhavesh for joining us today on this discussion. I'll start with a quick round of introduction. I'm Priya Sailesh, the growth coach and the leader for the investor transformation practice. I'd like to quickly introduce Neha Thomas, our global lead for the economic research and analytics team. I'm joined also by Khushbu Jain, practice head for healthcare and life sciences advisory practice. Amit Datta, leader for the wellness and nutrition practice. And then finally, Mr. Bhavesh Shah, managing director and head investment banking, Equirus Capital. With that, I hand over the presentation to Neha Thomas, who will be sharing her perspectives on the economic impact analysis. Over to you, Neha.
Thank you, Priya. I think it's a very exciting time to be talking about India's growth prospects, which were already strong, but with some of the positive news we've been seeing over the past couple of days on the trade deal, it's a particularly exciting time to be focusing on in India. So I'm going to start with our view of the global economic outlook, particularly where India stands. So if we could start with the world map slide, please. Great. So as you can see here, the global economy, the figures are moderately slowing to about 3.0%, but I would still term this as quite resilient growth, despite, some of the lingering trade uncertainty you have at a global level, some of the geopolitical flashpoints that you see. So I would still call this resilient growth. And that is pretty much the pattern we've been seeing over the past couple of years as well. So where do you see India performing, and also where do you see some of the other countries performing? The advanced economies, similar to patterns from previous years, are growing at about 1 to 2% growth. A lot of the growth is coming from the GCC region. You can see countries such as Saudi and UAE performing at about 5%. That is quite strong. India, without a doubt here, if you just look at the figures, is what you call your bright spot economy, or as you see referred to in the news quite often as the fastest growing major economy. We're expected to close this year at about 7.3% growth, which is phenomenal, considering a lot of the trade policy volatility we saw last year. So I think for this current fiscal, a lot of the growth came from domestic demand, your capex-driven growth. And I think it's these twin drivers of growth that have pretty much been supporting the Indian economy over the past couple of years, giving that domestic resilience push, despite whatever you see on the global scale in terms of external volatilities. And quickly just looking at the year ahead that we're entering into, we're forecasting India at about 6.5% growth, which is a moderate slowdown, but I think this is still very strong on a global level, particularly if you look at India's growth vis-a-vis, let's say, China, which you can see is structurally slowing down. So the 6.5% growth was done pre-budget, and we still expect growth to remain at 6.5%. Coming from a capex-driven push, which we saw re-emphasized in this year's budget as well. Domestic demand will continue to be a key growth driver, as well as some of your falling interest rates and the like. I do think we will keep a watch out and maybe revise our forecasts upwards a little bit to about the 6.7% range, just because of the positive momentum we've seen over the past couple of days with the signing of the mega India-EU trade deal, as well as some of the progress we've seen when it comes to the India-US trade deal. And these trade deals, they not only provide like a tailwind to Indian exports, once these are formally ratified, of course, but you'll also see a lot more confidence when it comes to investing in India, because there's improved on-ground sentiment when it comes to the Indian market. Moving over to the next slide very quickly. So this is a proprietary model of ours called the Frost Radar for Economic Development, which gives you a bird's eye view of how countries are faring when it comes to global economic development, particularly on the pillars of economic and trade resilience, future growth, innovation potential, and rising trade and volatility. So this is something we developed in 2025 and we're continuing the exercise in 2026. And it gives you an idea of resilient countries, particularly in the context of shifting supply chains, some of the trade conflicts that you're seeing, which are some of the stable and more secure countries to invest in. So you see here that Saudi Arabia, India, and the UAE are our top three rankers or front runners, sort of mimicking the high growth results you saw from the previous slides. So taking a quick look at the GCC countries, what is pulling their growth, in fact, is the fast progress in terms of their diversification away from oil, as well as their success in attracting skilled talent into the countries. But of course, we're talking about India today. So, what's driving Indian growth? So, like I mentioned, it is these twin pillars of robust domestic demand. And when we're talking about domestic demand, this is not a factor that we're seeing necessarily fading out over the next couple of years. I think our figures, in fact, show us that India is going to become the third largest consumer economy by about 2040, entering the top three league along with China and the US, which is a major feat considering that in about 2015, I think it was the 10th ranker. Right now, it's at about the 6th rank and making its way all the way to the third ranking economy, which is definitely going to support that domestic demand driven impetus. And of course, cost competitive production. And I think we haven't captured the extent of the FTAs completely in this model in terms of real time updates, but I do believe the pace at which India is rapidly signing free trade deals is a key driver when it comes to its go-to market resilience, particularly because I think the figures show that over the past couple of years, India has signed somewhere in the realm of about 8 free trade deals with about 38 advanced economies, which is massive. And it doesn't just end there. We're going on to sign deals with, let's say, or negotiate trade deals with a Canada or a Chile or a Peru. So that gives businesses a lot more investment and export competitiveness because, of course, you're trading at much lower costs than some of your other competitor countries. Moving over to the next slide, just focusing a little bit more on some of the key drivers that are sort of repositioning India when we're talking about the global supply chain and trade pivot. So as we all know, there is a global trade and supply chain pivot that has been happening, particularly I'd say from 2019 when the first US trade wars begun. You do see investments being rerouted, regionalization sort of growing, and new go-to markets emerging. What started as, let's say, the China plus one pivot. And we do see India playing a central role when it comes to the redirection of a lot of these investments. So some of the factors that's pushing up India, I'd say the first one is the scale at which it's signing the trade deals. That's already been covered. And of course, it's emerging as a pivotal nation when it comes to new investments. And I think we'd all agree that India lost a little bit of its attractiveness last year when it came to capturing new investments, because India, of course, hadn't yet made progress in a US trade deal when China and a lot of Asian peers had made progress in the trade deal. But a lot of this has obviously changed in the past couple of days. And when we're talking about manufacturing upgrades, we're seeing a lot of momentum towards higher value add sectors, whether we're talking about semiconductors and the like. So India has the ability to absorb global complex supply chains. We also saw this resonating again in the budget, whether you're talking about support for biopharma, whether you're talking about support for semiconductors and the like. And another point, of course, is the massive capex that's enabling a lot more investment in ports, freight, corridors, which is pivotal for logistics enhancement and more improved manufacturing competitiveness. So I think net, these slides should give you a quick overview. I do believe that India is at the cusp of a new economic era. India is ripe for its growth potential, and it is emerging as a go-to market and investment destination when you see a lot of the global FDI flows shifting. So with that backdrop in mind, I'm going to hand it over to Kushbu to shed some light, particularly when it comes to India's healthcare prospects. So over to you, Khushbu.
Good morning, good evening, good afternoon to everyone who's joining us from different parts of the world. I completely agree with what just Neha said. We've had a very exciting start to 2026. Talk about the EU trade deal, the US trade deal, the union budget, which appreciatively assigned a higher allocation to both healthcare and manufacturing. Now, I agree, these short-term catalysts, these near-term catalysts are very important. But in all of this, I don't want us to lose sight of the bigger picture. You talk about our demographics, we talk about our economic trajectory, we talk about our technological evolution. All of these factors are converging at the same time, and that's what's making this truly a promising decade for Indian healthcare. Now, when we speak of Indian healthcare, we have to look at it from both the lenses. We have a very strong supply story, which is anchored in decades of experience and legacy, and also an increasingly maturing demand side of the story. And especially when I talk about demand, we have to appreciate the fact that there's stronger synergy between our supply and demand, because the demand is increasingly looking and mimicking the developed parts of the world, the regulated parts of the world, the Western world. And by that, what I really mean is a lot of common factors are emerging. So if we talk about insurance penetration, we are already inching to that 40% mark. If we talk about middle income households, we are already expecting to grow up from 30% to 50% in the coming years. Most importantly, I agree very sadly, but most importantly, if I talk about chronic diseases, they are already accounting for 65% of the overall disease burden. Now, what essentially happens is when younger people start entering that patient pool, one, they're getting diagnosed with the diseases a lot earlier. There's an earlier onset of diseases, and the nature of consumption is also very different for these younger patients. So one, because they're going to be associated with the healthcare system for much longer, rather than episodic care, they actually want more continuous care. Secondly, they want to be involved more in their healthcare decision making. And thirdly, they're emphasizing more on outcomes and the experience that they get from the healthcare system. In all of this, if we start layering the fact that India is also emerging as a hotspot for medical tourism, and all these medical tourists actually demand premium, high quality, outcome driven, very specialized care, we are looking at a very different scope of demand when I compare it to the last 10 years. Now, let's flip this side a little bit and look at the supply constraints. We are all fully aware of how we need 3 million additional hospital beds, we need 2 million additional healthcare personnel to cater to this demand in traditional models. As enterprising as India and Indian companies are, we have started adopting new models to exactly solve for this problem, because these changes are not going to happen overnight. We are already seeing decentralization of care, which means we are moving away from hospitals and more towards home and closer to the patient. We are using more of technology. In fact, there are recent surveys that indicate that almost 40% of clinicians are already using some form of AI in their clinical workflows, be it for reading images, be it for documentation management, be it even for clinical decision making. So they're increasingly leaning on these technologies, which are plugging in that resource gap. On top of this, like I talked about, when we look at chronic care, the chronic care delivery is very different from acute care delivery because, like I said, it's not episodic in nature. Once the disease has been diagnosed, it requires lifelong management of that disease. Now, in this, what we also have to understand is that, yes, the demand is evolving. It's mimicking that of the regulated world. But at the same time, we also have to deliver all our solutions, be it services, be it products, at least 30 to 40% lower cost. Now, what that actually means is that it gives us new growth vectors. So if we get on to the next slide, Hannah, please. Hannah, can we move to, yes, thank you so much. So the way we see it is, it's a dual growth engine which has also created a lot of investment opportunities, especially for 2026. So if I talk about the very first growth engine, it's our scaled manufacturing, and we have a very strong legacy in this. So when I talk about manufacturing, this is again on both fronts, pharmaceutical and medical devices. Within pharmaceuticals, we all know we have gained a significant edge in manufacturing. We are rightfully crowned as the pharmacy of the world, and our CDMO industry has grown magnificently. Now, the CDMO industry will continue to grow for two main reasons. One, our domestic demand is increasing by 10 to 12% every year. So we have to cater to that domestic demand while reducing our import dependency on China. Secondly, given all the global factors, if we talk about Biosecure Act, overall trade tariffs, overall pricing pressure on pharmaceutical companies, these companies have to leverage outsourcing from more affordable destinations like India. So they are leaning incrementally on our contract service providers, which means that our contract service industry is definitely going to grow at least by 12 to 15% in the coming years. Now, we have had that legacy in small molecules. It's not even up for debate. But given the new schemes that the government has introduced and the overall push from the private sector, we actually expect very strong growth in the biologics and the complex injectable space. We talk about the Biopharma Shakti, we talk about the PLI schemes, we talk about the bulk truck parks and shared infrastructure that's coming up. That's what's going to provide that necessary thrust to that industry, which is considered as both high margin, high value, and where the future of biopharma is moving. Similarly, for medtech, again, this rightfully is defined as a sunrise industry of India because we're looking at a 15 to 20% demand growth. But unfortunately, we've had almost 72%, 80% of dependence on imports to meet this demand. And if I have to look at the silver lining, it just means that we have a lot of headroom to grow. We are already seeing increasing investments, both from the public and private side, for Indian companies to start moving up the value chain. We're transitioning away from low-cost consumables, which is where our manufacturing is focused, to more high-end devices, largely in the category 3 and category 4 devices. But if we have to talk about that next wave of growth, that will truly come when we start replicating the success for our pharma model, which means that we start catering to global demands. And for that, we need to understand what does the global demand look like. It's largely for a combination of hardware, software, and AI. Think remote monitoring, think digital pathology, think surgical interventions. All of these solutions is where we will see a lot of Indian companies to start investing and drawing in more investment. Moving on to the second growth engine, that's mostly on the healthcare delivery model. So we expect a lot of investment and a lot of growth to come from specialized precision healthcare delivery. So that essentially means that we'll see a lot of hospitals that start serving as centers of excellence, and they're super specialty hospitals that are not simply catering to the increased middle income households, but also medical tourists that are especially flocking to India for this care. Now, when we talk about these hospitals, big areas of growth will be around cancer care, cardiac sciences, ophthalmology, and even renal care. But for these hospitals to truly be qualified as centers of excellence or specialized care hospitals, they will have to lean increasingly on advanced technology, where we look at multi-omics, not simply for diagnostic, but also for therapeutic selection. We have to look at surgical interventions, not purely from robotic interventions, not purely from surgical point of view, but beyond surgical interventions as well. So this will be one growth center that will be a little more immune to what's happening globally and the overall volatility, because a large pocket of this growth will be derived from our domestic demand. Similarly, AI and software platforms, which are very well embedded in our clinical workflows, is another area that will draw a lot of investment. So when we say software platforms or AIs, This is getting a significant boost given Government of India's incremental focus and investment in the overall health stack infrastructure. So all of these become a multiplying factor for this sector to grow. If I have to overall say, India's growth is very well defined because it's not cyclical, it's not purely opportunistic, it's based on fundamental structural shifts. And we are confident that India has a capability to emerge as a healthcare high capability economy. And on that positive note, I'll invite my colleague Amit to share his views.
Thanks, Khushbu, for the introduction. Yeah. So when we speak about the, I would say the consumer space, the FMCG and food space, firstly, what we like to cover as part of this conversation is what are the key global trends that are driving the entire food economy, to be particular. So first important part when we look into the last few years post COVID, and then after these global concerns due to Middle East and Russo-Ukraine conflict, there were a lot of food security concern. There were by in 2022-23, I would say the food prices globally were at its peak, and it has come down a bit, but still the concerns are still there, and that's where all the countries, all the global economies are focusing itself on achieving food self-sufficiency. That are the biggest drivers in the food sector currently. Second important point is looking at the shift in consumer pattern. The consumer pattern has largely shifted towards health and wellness. So when we are speaking about food security, it's not only about food; it's also about nutritional security, and that's where I think the globe and as well as the India market is also moving towards. Third important aspect, when we look into the overall global market for food and beverages, it's large. It's huge, about 12 trillion dollars by 2027. This currently might be around 9 to 10 trillion dollars, and that gives an immense scope for growth. Followed by, I think the most important aspect is the supply chain disruption, because all the large global food companies or the economies have faced a lot of disruptions and still ongoing post the tariff related uncertainties, Middle Eastern and Russia-Ukraine conflict, and all these economies and all the companies have adjusted through various innovation and diversification in value chains, and that is going to be the drivers in the coming years. And also moving towards sustainability concerns, definitely we are not looking only at a economy which is only I would say growing. We are also looking at economy that is sustainable, and same is with the food segment, because you also need to look at whether your food is sustainable, it's sourced ethically, and it's also circular in nature. I think that are the key drivers, particularly when we look at the Western world, and this trend is slowly and steadily moving towards APAC and India as well. And few other aspects to keep into consideration are the cost reduction, productivity pressure, as I think mentioned by Neha in earlier discussion. India is obviously has one of the key cost competitiveness, and cost competitiveness is driving the global, I would say, the trade, and whoever is competitive on the cost point of view, I think are the winners in the, I would say, in the entire trade context, and that's where I think India is leading the race at present. And then not to be I would say, but not the least, is the digitized food supply chain, whether it's integrating the supply chain with various AI based initiative, blockchain, IoT. I think this is the way forward, and all the global economies, the companies have to emerge to the trend and enable their own supply chain more, I would say, technology oriented, as well as use various, I would say, automation tools, including IoT, big data, and blockchain as one of the key drivers of the food processing sector at large. Last but not the least, I would say, is the food and beverage regulations, because these are also driving the entire export markets. Not only the export market, also the domestic economies. People are getting more health conscious, as well as I would say sensitive towards the food safety concerns. I think these are the points, I think from the global aspect, which are again driving the Indian food processing sector as well, because these are slowly and steadily also disrupting the Indian market. Can you move to the next slide, Hannah? Now, when we look at Indian food and I would say food and wellness or food and beverage industry, by FY30, it's expected to reach around $1.6 trillion. That's huge, and that's around, I would say, almost around 8 to 10% of the global food and beverage industry. Now, what are the drivers? I think already being covered from the domestic demand aspects. India is the fourth largest economy from the consumption aspect, and is moving towards the third largest economy by 2040, increasing food processing levels. So by in 2010, we were at roughly around 6 to 10% of entire food which was produced in India was being processed. Now this has slowly and moved towards around 20 to 30% levels, and but there is a huge scope for growth, because if you look at all the developed economies, the processing levels are much higher, even more than around 40 to 50%. So that's where I think the growth is going to come in the food sector. Favorable demographics, the Gen Z, and all the I would say growing the middle class, all these factors are also driving the growth. And in terms of the lifestyle and food habits, definitely health and convenience are the factors which are driving this domestic demand. Now, from the supply side advantages, India has always been on a positive when it comes to supply side advantages, because of a huge, I would say, agriculture basket of India. India is one of the largest producers of fruits and vegetables, multiple cereals crop. I'm not going to in detail about it. At the same time, India has more than 26 plus agro climatic conditions, so you can grow each and every crop within different parts of India, and that's where India has a huge, I would say, benefit, and where all the global economies are looking at self-sufficiency. India is already self-sufficient in nature, and they're also are one of the key export baskets globally. Second important point on the supply side is the resilient value chain, which I've already covered as part of the global drivers, and that's also driving the Indian supply side growth. And third important aspect is the globalization strategy. Most of these companies in India are looking at how to localize the manufacturing, how to limit your, I would say, imports, and how to make in India post the, I would say, government intervention in terms of Atmanirbhar Bharat. I think in 2021, government launched the PLI scheme, and there was a huge impetus on the food processing sector, and it has grown largely because of driven by that. Third important aspect, which I would like to cover, is export opportunities. Like India had targetedly increased its exports, particularly in the agriculture and the processed food side, and it is also growing largely post the EU-FTA agreement in place. Definitely, there will be much more growth in the, I would say, for example, the marine produce, the fruits and vegetable processed foods. Many of these products are going to be much more cost competitive in nature in these markets. At the same time, post the US, I would say, easing of US tariffs, I think that is also going to be a huge breather for the Indian exporters, and I think that is going to take a positive seat in the coming days. Focus on health and wellness and sustainability. I think this is the most important driver when we look at the processed food segment. If you look at all the food processing companies, larger food companies, all the companies are diversified in the functional foods, either through organic or through inorganic route. Just recently, in today's news, you can see Marico acquiring 60% stake in Cosmic Wellness. Cosmic Wellness is into protein-based products, and that's where I think most of the growth is coming from. This sector itself is growing at more than 15 to 20%, because of the huge, I would say, consumer awareness and mindfulness of the consumers towards health and sustainability. I think that is going to be the most important driver in the food sector, and to sustain in the markets, to sustain in the economy. I think that's going to be one of the key drivers. Conductive government policy. I think my colleagues have already discussed about the, I would say, the positive, the budget which has come in place in February on impetus on the food processing sector, impetus on the agriculture sector, impetus on the fishery sector. I would not get it in detail, but schemes like the PLI, PM Kisan, Matsya Sampada Yojana, GST reforms have already been in place, and that is also, I think, furthering the growth in the sector. And also a lot of FDI coming into in automated route, lot of increased interest in global and private equity and venture capital funds. Just I would say, just to give an example, say one sector in the food, which is the snacks and savories. We are proud of the snacks and savories segment because it is one of the, I would say, indigenous sectors to India. So if you see the investment coming in, so there has been investment coming in from Singapore through private equity route, then investment from I think from one of the private equity funds in Balaji Wafers, and recently another investment coming into one of the other frozen potato companies. This is just some example I'm quoting, and there are multiple examples to go for. And similar is the story in the functional food segment. One of the key factors which I would also like to highlight to all the participants in the discussion today is, why is India preferred destination for all the for all the investors, as well as all the I would say all the private sector, global private sector companies, because of the huge raw material base which we have, because of the obviously the I think the labor competency which we have, both from the skilled, semi-skilled, and from the unskilled labor. That's where India currently is standing at, as well as the conductive government policy, which is furthering the growth in the sector. I think that's where I would like to finish at a positive note, and I would like to hand it over to one of the esteemed speakers for today's panel, Mr. Bhavesh Shah. Mr. Bhavesh Shah comes with more than 30 plus years of experience within the investment banking space, and he has I think he leads the consumer healthcare technology industrial BFSI practices within Equirus, and I would like him to highlight some of the key aspects, how the industry and how the capital markets are looking forward in 2026. Over to you, Mr. Bhavesh.
Thank you so much, Amit, and thank you, Frost and Sullivan team, for having me here on this esteemed panel. It was good to hear views from Neha on the overall economy, Khushbu on the healthcare, and Amit on the consumer. These are all very attractive sectors, and India is also a very attractive country from an investment standpoint. And I will just want to share some few slides to kind of demonstrate that. I just want to check if we are able to see what I'm presenting.
Yes.
Okay, cool. So I think if we were to look at where India, clearly it stands out in terms of stock markets. I think it is a place where we've seen a good amount of sustainable growth that has happened. This is a slide on the Sensex performance, right, going back into decades. It's from 1980. We've seen some consistent amount of returns being generated by the country. And we obviously saw a good amount of downturn during COVID, which was on the back of a very weak decade. But after that, we've seen some significant amount of resilience, and the market has gone up significantly. And one of the very key trends within that is we have seen the FII flows always, as we have seen, has been always been volatile, and more so in the recent times. We have seen a lot of exits that have happened from the capital markets for the FIIs. Then the net inflow last year was almost $19 billion. I think, but one of the major remarkable things which has happened, or a tectonic shift which has happened in the Indian capital markets, is the inflow of the domestic capital markets, or the inflow of the domestic funds coming into the market. So we have seen a sustainable increase in the DII inflow, and so much so, if you were to really look at the ownership of companies, where they were largely like outside of the promoters or others, if you look at institutional breakup, the foreign institutional investors who held almost 21%, and 14% was DII. But now the trend is reversed, where the DII holding has gone up to 18%, vis-a-vis that of FIs have come down to 70%. So which again is a we can call it as the Atmanirbharta of the Indian markets, or a democratization of the Indian markets. And largely this has been the DII strength has been largely because of the significant increase or a gradual increase which has happened in the systematic investment flow, which adds to the mutual fund industry. So there's almost 30,000 crores worth of money, which kind of comes in every month into the mutual fund industry, which needs to be deployed both in terms of the stock markets and as well as on the capital market side. Today, the equity portion of which of the mutual fund has gone up significantly to a dominant position of 60%, vis-a-vis that of the other asset classes within that. I'll now take you to some slide. What is that impact in terms of what is the impact of that in terms of capital markets? We have now seen a significant amount of capital raising activity which has happened in the Indian markets. Last year we saw almost like more than 100 like a century crossed for a number of IPOs that was done in 2025 calendar year. This kind of parallels where we were just before the GFC way back in 2007. We had seen a sustained activity going up over that time on the back of increased liquidity globally. But here, this activity which we are seeing is largely based on the DI activity, which is kind of, which is the self resilient kind of a capital market activity which has gone up. The other trend which I would want to bring out is in terms of the IPO money raise. So while we saw a lot of activity way back in 2006, 2007 in terms of number of IPOs, but the money being raised is the historic high for India in the last I would say last 4 to 5 years, and we saw almost 1,75,000 crores being raised from the capital market last year, and which almost like was a similar amount number in 2024. We are expecting in 2026 a similar amount again to be raised, although we have seen a little bit of a lull in the first few weeks of January this year. But we expect the activity to pick up significantly in the coming year to maybe even cross the last 2 years' numbers. 1,75,000 crores. We expect this year to be around $20 billion. If I were to look at now, this is a very interesting statistic. If I look back at in the Indian capital market for the last 25 years, which is start of the century 2001 to 2010, we saw almost 2 lakh crores being raised, which is 2.37, is 2 trillion rupees being raised through 458 issues. This is the first decade. The second decade, which is 2010 to 2020, we saw again a similar amount of money being raised, 2.2 lakh crores compared to the previous decade. But in this decade, in just a half of the decade, we have seen an activity of 5.8 lakh crores being raised. That I think is a very significant jump up in terms of activity. Now, if you were to put these things in perspective, it's a 20 years of fundraise being happening in 5 years. That's a very, very big shift which has happened, and I think it's happened on the back of the sustained flows which have happened. The average IPO size has gone up. Now, this actually brings out, if you were to really things again, put things in perspective. I'll go back to the previous slide. So, if you really put things in perspective, we always saw the Indian capital markets to be very FII dominant, and that really dictated our capital markets. And so I remember as investment bankers, we always used to have one slide which we used to present to our clients that there is a window of opportunity to raise capital market or do an IPO. And that window of opportunity would typically be 1 year out of 3 years. So there's nothing happening in 2 years out of the 3 years. There's only 1 year where IPOs will happen. Now that added a lot of kind of an uncertainty for many companies, right? I mean, how do I raise money? So the money was being raised through banks. And in fact, I personally feel that the private equity really took big advantage of that and kind of, said that here's my money, which is perennially available, but I have my own terms, bells and whistles, and the return expectations. So we of course saw a lot of private equity deals happening in those periods. But I think with the new shift which has now happened in the capital market, which I call as a tectonic shift, I think capital market IPO activity is going to be much more sustainable kind of an activity and not a very sporadic activity as we had seen before, which really adds one more level of corporate finance avenue for the companies to raise money. Coming to one of the other aspects that we have been observing in the market is this is a percentage of offer for sale as a money raised. So interestingly, a lot of companies that have been coming into the capital markets, they are offering shares, or the stakeholders are offering shares more than raising money. In my view, there's a lot of debate whether there's a good trend or there's a bad trend. In my view, it's a very, very healthy trend. Reason being is because it's providing a lot of exit to the earlier risk investors who had a lot of put in primary capital in the business to grow the capital, to grow the business. And now since the business has kind of stabilized, it's maturing, it's growing from here, they want their exit, they want their returns, and that's how they're kind of giving the shares for the capital market investors to kind of run the ride from here on. And this, I think, why I think again it's very healthy is because there was a time when, and you can see this over here, that the offer for sale in the earlier part of this century again was very small component. A lot of money was being raised through primary, which effectively meant that a lot of companies who really wanted to raise money always would only come, which meant that the cash flow generation capability of the company is not very good. They always want to raise money and they want to kind of get into capital markets. Now it's very counterintuitive from a capital market investor. Investors always want a cash throwing business, a cash generating business. Now you cannot have a situation where a cash generating and a cash throwing business is always raising money on a primary basis. So the best way to play those companies is to kind of buy from on a secondary basis. Now the good news is there are a lot of listing benefits, and which is why the corporates, they kind of want to list, but because there's no capital market, there's no primary need in the market, in the company, they're offering their shares in a way to kind of monetize and kind of create listing value and the more overall value. This is the other phenomenon that we've been witnessing. With this, we've seen a lot of exits that have happened. This is for the private equity. Now, the way for private equity investors who had been kind of investing in the capital markets, I wouldn't say taking advantage of lack of capital markets, but they had invested. So the exits for them could be through by way of secondary sale, by way of a strategic, or by way of an IPO and a block deal thereafter. We have seen a good amount of increase in the capital public markets activity, in the last, I would say, 4 to 5 years, which has provided very good exits for them. In fact, on the back of these exits, the private equity investors have been able to raise a lot more money, or a dry powder, as we call it, for them to invest. And in my personal opinion, supply always creates demand. The more the supply of money on the private equity side will create more demand. So I'm expecting the private equity activity to go up significantly. This is some data around the private equity, investments we had seen, as I had mentioned earlier, the private equity took advantage of capital markets not being, or rather being very sporadic. So we had seen a very healthy trend as far as private equity investments are concerned, going up to almost $40 billion and even up to $51 billion. A lot of these investments over here in the later part of the last decade was more in the, I would say, the new age businesses, which required money to be spent for growing, or using equity money to burn so that they could pass on the discounts and kind of grow. But quickly, I think the market realized that that's not the way to grow the business. You need to have a very profitable business model, and which is why we saw a bit of a funding winter in the private equity space probably in these years. I think the last 3 years, which is calendar 22 to 24, a lot of the businesses have used that opportunity to kind of repivot their business to making it much more profitable. And the ones who have been successful in able to do that, they have been able to raise more money on the private side. Some of them are able to go public as well. So we expect the private equity trend to kind of really go up from here. The companies have pivoted themselves to becoming much more profitable. B, there's a good amount of money which is now available as a dry powder for the private equity investors on the back of exits that they have created. So we expect the private equity trend to kind of really improve from here on. So I think if I were to really sum up in terms of the activity, we are expecting good amount of private equity activity. We're expecting some good amount of capital market activity as well. But one more good trend I would want to kind of highlight over here, even on the capital market side, is we are seeing more and more IPOs coming from tier 2 and tier 3 cities as well. Which I think is a phenomenal situation, because it talks about a very Bharat more than an India. It's more of an inclusive Bharat that we're talking about. And I'm myself amazed. I'm going to places where I've never been before in India for work. And when I meet with companies over there, they're extremely scaled up businesses, very good quality company, good management, good business models. And I expect that activity to scale up significantly as we that provides more good quality companies to come in the markets. We're also going to see a good amount of surge in the new age and digital economy companies coming for an IPO. We are already seeing that through a lot of good IPOs that have happened in the recent past, like Lenskart or Misho's of the world. We are expecting a lot more to come this year, and also very good large cap companies like we're expecting Geo to happen, probably this year. NSE has we're just seeing some news around the SEBI clearance that they have now got, and I think the activity on that will pick up. SBI Mutual Fund, again, a very large IPO that will come. So we're going to see a good mix of very scaled up IPOs that will come. We're going to see a good scale, mix of new age businesses and businesses coming from tier 2, tier 3 cities. So and private equity also kind of witnessing an upturn. So I think from a overall capital market standpoint, and just to add to what Neha mentioned, we are also on the economy front. The trade, US trade deal has happened, which brings in a lot of confidence from foreign investors. The rupee dollar rate had been severely beaten, which again provides a good opportunity now for the FIs to come in. So last year we of course saw $19 billion worth of sale of FIs that happened. But my personal view is a lot of money went to places like Korea and Taiwan on the back of AI play that was being happening there. And the valuations over there have gone through the roof. We are expecting some correction where that money, they will sell in markets over there, and some of the monies will start coming into attractive places like India. India is now much more stable from a overall fiscal deficit, and a debt to GDP is also concerned, as we all saw it in the budget and as was highlighted by Neha as well. But I think we are in a situation where the economy is good, the capital markets are good, the businesses are good. I think one of the things that we will need to watch out for is the companies that are looking to raise capital. They need to definitely perform. They need to kind of deliver on the whatever promises they make. That I think is going to be key. As long as that is happening, we're going to see some very good activity happening here.
Hey, thank you so much, Bhavesh. That was a very insightful, presentation and views for a promising 2026. So I'll just take the next few minutes, to capture all our positive views and open it for a very brief, 3-4 minute panel discussion before we conclude the session. So few key points fractured. There were 3 in the last 7 working days. We have had 3 big things happening. Everyone reiterating it. I'm just reiterating it again. 1, the historic 20-year-old Indo-EU trade deal, which has opened a lot of new windows for Indian companies, right? We are opening and expanding our export presence from the historic destinations to we have had a important budget focusing again on two things: Viksit Bharat, making India as a reliant, in terms of manufacturing, based on a growing consumption demand, right? That's also important. 3, increasing number of consumers not coming from the traditional tier 1s, metros, tier 2s. They are expanding beyond that. Penetration of technology, especially the e-commerce, more and more people using phone. All this is boosting the demand, right? 4, then came the unexpected bounty in terms of the surprised Indo-US trade deals, where 25 to 18, a lot of debates are going on this, but positive way to look at it is 18% reduction, vis-a-vis slight competitive edges over some of our neighboring nations. So this opens up a huge amount of windows, not just for industries, thereby the equity also flowing back to India, right? So with that, I'll first, Neha, what is your outlook in terms of whether this trend and what you have spoken about will continue in 2026? So we are emitting positivism, but what are your thoughts on this?
For sure, Priya. Like, it's one thing for an economy to become the fastest major growing economy in 1 year, but to hold on to the tag for like 3 to 4 continuous years, it's not a one-off event. It's clearly a scale that we built and confidence that we continue to repeat year after year. So I do believe that we are ripe for growth. And a lot of this growth that you had mentioned and Bhavesh had also mentioned, that story is going to start to pivot from our metros a little bit more towards the tier 2 and tier 3 cities, which are going to become the engines of growth over the next decade.
Okay. Khushbu, in your presentation, you spoke about 4 engines. CDMO and pharma, we all know that. We spoke about medtech. We spoke about hospitals. The growth story is known. And this year, we are also expecting a lot of PEs and funding to come into the hospital sector, and more hospitals, not just the pan-India hospitals, but also the regional hospitals going public. We also spoke about AI technology. We spoke about home care. So these are the 4-5 trends that you spoke about. Or if I ask you, from these 4-5 trends, we have seen a whole lot of capital into the CDMO and the API space. What is your outlook from 2026 with especially the recent deals being announced? You're on mute. We're not able to hear you. Yeah. Okay. So I think we'll pass it on. Amit, 2026 also is starting off with a lot of investments being announced, acquisitions happening. We have some leading food brands, QSRs, restaurants, all going the IPO way. Wellness and nutrition is coming back in a big manner. And a lot of PE funds are also investing in those sectors. So what is your outlook for 2026 in terms of the investment story for India? Khushbu, we'll come back to you later.
I think Priya, Bhavesh has also covered very I think, in detail about how the entire market is looking, particularly the trend in the from moving towards tier 2, tier 3 cities. And that's what we expect in 2026. A lot of SMEs, small and medium enterprise, medium scale enterprises are going to bring in more investment. Government is also putting a lot of emphasis on it. I think that is going to be one of the key drivers. And second important is the consumer itself, because consumer is the king in the FMCG and food space. So there is a lot of emerging trends. The consumers are willing to spend. I would say, from the NSS survey also, the amount of spend on the F&B has been increasing. Not only that, also spend in out of home consumption is also increasing, and these are the positive trends from the consumption point of view. And a similar story is there from the demand point of view, because of the positive, I would say, the infrastructure growth and the impetus in the union budget for 2026 on Viksit Bharat. Some of the other areas within the agriculture, which is the production point of view, is going to take the economy forward. And I think the 2026 looks much better than 2025 itself. And I think the growth story is here to continue. Here you are on mute.
Khushbu, over to you.
Yes, thanks, Priya. So what I was actually saying was, in addition to all the trade deals that are going on, an important factor, especially for CDMOs and why it makes us bullish, is the Biosecure Act. It's an act that was tabled for almost 2 years, which finally got signed last December. So that's also something that will transition a lot of demand from other parts of Asia Pacific, especially China, back to India. So that could drive growth. Another thing, and a fear that I want to allay and why I want to reiterate why we are bullish about this, is there's been a lot of talk about onshoring and how manufacturing needs to move back to US. But it's not that easy, especially in case of pharmaceuticals and especially away from India, because our growth story is anchored in a bigger ecosystem picture. We have a strong chemicals industry. We are increasing our presence in intermediates, in APIs, and of course in formulations. So moving that entire setup is not that easy, not that profitable, not that viable, which is why we remain confident that CDMO is a very good, strong sector for India.
Thanks, Khushbu. Bhavesh, we have heard the perspectives of the team. If there are, two or three messages that we want to capture from this conversation, we hand it over to you for your perspectives.
Of course, thanks, Priya. I think I covered a good amount of, in detail. As I mentioned, I think, a lot of companies, in my view, they think that, we should wait out for some more time before we do anything in terms of capital market raise or a private equity fund raise. My view that this time is golden for India. I think there's I think as long as the businesses are the people have entrepreneurship, as long as the business model is good, I think it's really important that whatever business that the companies are into, they have to make sure that it is a differentiated business, and it creates value to the society and overall. And it translates into numbers from a shareholder's perspective, of course. But I think this is a great time. There will also be a lot of opportunity for M&A to happen, because not each and every company will be worthy of raising capital from private equity investors or for going for an IPO. It's best that rather than be very kind of not growing company or a very kind of a lackadaisical businesses, etc. So I think it's best that they get absorbed in a bigger platform which can actually raise capital market money or private equity investors money to see an overall growth. So again, and as I mentioned, Priya, I'm looking at a lot of positivity around all activities, which be it a private equity fundraise, capital market fundraise for companies who can do it, and for companies who cannot do it, it's best kind of get into the consolidation phase. So I'm looking at a lot of M&A activity also happening across sectors.
Okay. Thank you, everyone, for sharing your perspectives today. Thank you, Neha, Kushbu, Amit, and a big thanks to Bhavesh for taking his time and sharing his thought processes.